Hi guys, okay, let's get cracking. So we did a video previously on what was an edge, and we were looking at trading an edge versus random trade and the difference between the two. So as we know, an edge is a set of variables that when present there's a higher chance of one thing happening over another. In terms of price, when these variables are present, price are more likely to move in one direction than the other over time. And then over 20, 30, 50, 100 bets, we will then have a net profit and our edge will start to work for us. So amplify, give an edge. The breakout classic is an edge. But we can actually make our own edges from basically anything, joining technical tools together and build our own profitable edge. So that's what we're going to go through here together now. There's tons and tons of edges. You can make an edge out of basically anything, but they're usually broken down into two types. You've got your trending edge and you've got your mean reversion style edge, right? So your trending edge is trying to get on the trend via breakouts or pullbacks, and a mean reversion is basically when price moves one way, get in the direction in the opposite ways and price comes back. Now I know we all know about the building blocks of an edge is an equation, right? There's maths behind an edge. So I've got this tool here. You've got your win rate and you've got your risk to reward, right? Now this basic maths is the foundation of every single edge there is. For example, with a trending edge, your win rate will be lower, but your risk to reward will be higher, okay, as you try and catch the pullbacks or catch the breakouts, but you're trading in the direction of the trend. And so net overall, over 50 trades, this should add up to a profit. For a mean reversion style strategy, your win rate will be higher and your risk to reward, your wins, will be smaller, as you're just trying to catch those sort of 2-to-1s or 1-to-1s for mean reversion, you know, where you're just picking the tops and picking the bottoms, and you're just taking the top of the Bollinger Band back into the average, bottom of the Bollinger Band back into the average, those little 1-to-1s, but lots of them, high win rate. But with the trending stuff, you're getting 3-to-1, 4-to-1, 5-to-1, but not very often. So the strategy that we're going to build today is a trending strategy. It's really dead simple. We're going to look at an edge usually has a core sort of thesis around it, and then we're going to layer the edge. We're going to layer the edge to make it win more or win bigger, all of that sort of stuff. So look at the relationship between the S&P on a daily chart and the 200-day moving average, right? So every time, the thesis is that every single time price dips into the 200-day moving average, we're just going to buy it, right? That's thesis number one. If we look at back here from 2016, and we're going to write it down, we just take every single time price moved into the 200-day moving average, we're just going to execute a buy. And the exit strategy will get out for like into the previous highs. So you've got a test here, that's one. We've got a test here two. What sort of stop loss will we have? Say like a fixed 10-point stop loss. So 10 points is not a lot, is it? Maybe say 20-point stop loss, just to begin with, because this is going to be the core of the edge, right? And I've got some really interesting ideas towards the end of ways you can spruce the edge up. So you've got one, you've got two. How far did this come into the average? So on a fixed stop loss, you'd have been stopped out on that. So you've got, I'm just going to type this in here because we need to make some notes, because what layering will do, hopefully, is it will boost the win rate and it'll boost other areas of the strategy as well. So currently we've got one win, one loss. We're going to go along to the next time, just entering straight off the moving average. Probably would have taken a win there. How far did that come in? Taking a win there as well. So decent strategy, this sort of 200-day moving average, but it doesn't happen very often. It's certainly not intraday. Now that would have been a stop out. And that would have been another winner there. And that was another winner there. And again. So since 2016, you've got 6 winners and 2 losses every time that 200-day moving average was tested, right? So how about if that's the core sort of thesis behind the strategy? So how about if we layer with that some bullish price action? So now, rather than just entering into the moving average on the test, now we're going to wait for some bullish price action, like an engulfing candle or a hammer type candle, that sort of candle. And I'm adding this second layer of edge. What impact does that have to the statistics overall? Does it improve them? Does it make them worse? You know, that's what we're really looking for in this second layer of edge. So then we go back and back test it and have another look at this. Does it have other like adverse effects? Does it lower the win rates? Does it lower the risk to reward so much that it doesn't that it makes it less profitable over time? So you can see here that actually as price moves into the moving average, we break below the moving average, and then no entry yet, because when we come back up, we've got this bullish engulfing candle pattern. So that's 2 layers of edge now. But our stop loss would have been just below the candle pattern at 20 pips. So here we've got a winner. But what's interesting about this example right off the bat is if we would have entered straight into the moving average with a 20 pip stop loss, we still would have won. So no difference there. You can see what I'm getting at. So this one here was a loss. This is a really interesting example. So I believe this was the presidential election in 2016. We would have entered straight into the moving average here. We would have taken a loss. But by the close of the session, we had this monster hammer candle. Now, risk to reward's not great. You might have wanted to wait intraday, but we'll go through that as another layer of edge later on. As maybe a 4th layer of edge. So we would have taken this, and all of a sudden this losing trade would have been turned into a winning trade, right? Just using that second layer of edge. So now we've got 2 wins and 0 losses. What about the next one? So here comes into the moving average, strong bounce, you're miles away. You might have said, well, that's too far away, you know, the stop loss is too wide. See if it comes back in, and it does come back in. And rather than entering here, we might have entered here. Taken a loss on that one, so we're taking a loss there. We break below the moving average, then we've got some bullish price action there, and that gets us in a winner, right? And again here, but a bit of a loser, right? Yeah, bit of a loss there. And here, see, we've got the hammer candle off the moving average there. Awesome little reversal pattern there, and we've got a winner. And again, we come below the moving average, and then we come straight back up again. See this little green candle? That's not a bullish candle pattern of such. It is a green candle, but it's not a bullish candle pattern. This is the bullish engulfing candle here, straight back up above the moving average. And again, another winner, but that one would have been a winner anyway. Just want to have a look at this example. To the tick, not sure whether that one would have worked. Sorry, I've got a question here. What would be interesting to see is how long does the position stay active if you weren't stopped out? That is an interesting question. We'll come back to that. I'm not entirely sure what you mean as well, Charlie. If to sort of clarify that, please, and then we'll try and answer it. So that's with 2 layers of edge, and in fact, the results this time are exactly the same. So what we're going to do now, we're going to do some maths, right? Before I jump into the 3rd layer of edge, which will really make a big difference, do some maths. Or let's imagine that, you know, for argument's sake, I think we managed to reduce one of these losses. But anyway, so we got 5, 6, 7, we got 8 trades in total, right? 8 trades. Imagine we were risking $100 on each trade, and these trades were sort of, what were they like? So our exit strategy would have been, we were risking sort of what, 20 pips, 20 points, sorry, for 80 points, 4 to 1. So then we've got 4 to 1. So we're risking 100, making 400. So then over those 8 trades, we got 6 winners, 2 losses. So we've got 6 times 400, and we got 2 times 100. So that's 2,400. And what we're going to do is we're going to screw around with these numbers quite a lot to get the most amount of juice out of them as possible. So here, I made a profit of 2,200 just on that little strategy. And unfortunately, the 2nd layer of edge didn't really make much of a difference. But let's imagine you've got a little, don't want to diverge too much, but let's say we've got mean reversion intraday strategy on a 5-minute time frame where you're using a stochastic, and then you backtest the stochastic on a 5-minute, and you realise that actually when the stochastic's overbought and oversold, taking entries there is not a profitable strategy. But let's add some price action into the mix. Let's add some support and resistance into the mix, and all of a sudden now we've got profitable trading strategy, layering those edges on top of each other, layering those filters on top of each other in order to build a strategy. But there are some sort of, other than just technical tools like pivot points, stochastics, support and resistance, moving averages, there's some other cheeky ways you can add edge into a trading strategy. And one of my favourite ways is money management as a layer of edge. So with money, what do I mean by using money management as an edge? Well, especially with swing, not so much intraday, but you can. We'll go on to a 4th layer of edge in a minute. But what do I mean by using money management as an edge? Well, pretty much not entering full size straight away. And so, especially with strategies that have got a little bit of a higher loss rate, instead of going in full size on the first entry, actually going in maybe a 1/3 size, half size, and then when the market starts to move in your favor, start adding to it. But you're not necessarily going in full size, doubling up, tripling up. What you're doing is you're going in sort of a 1/3 size, then scaling up to a full size, and then maybe adding a little bit on top of that. And what that does is that on the losing trades, you're in a 1/3 of the size, and on the winning trades, you're in full size, possibly even a little bit bigger than full size. And so when the market's moving in your favor, you're in max, and when the market's moving against you, you're losing small amount. And then you would come up with some sort of, so let's say that what that would do to the numbers over here is that would, rather than 100 on the losing side, that would now be reduced to 30. So that'd be 2 times 30, wouldn't it? In a 1/3 of the size. So then you would, so instead of 200, that would now be minus 60. And what that does is that boosts, that'd be 2,400 Oh, minus 60 rather than 200. And obviously the higher the loss rate there, I can't actually add up, 340. So now this is a lot more than what that was originally, right? So then what about, and that's my favourite way of boosting the numbers. And then a final way is to line up multiple time frames. So what you can do is, what you notice is, especially with these candle closes off the moving averages, is that the stop is super wide, right? So you've got a trade here. Let's take a look at this example. You've got a trade here, which is, you've got to have at least a 20-point stop loss, right? I think that's 20. Is that 20? Sorry, that's in ticks. 50 points on the stop loss, right? And then the target is maybe back up to these highs. So 100 points. That's actually 2 to 1. Not a great trade, right? So is there any way that we can boost this? Well, of course there is. Let's take I wouldn't be able to scroll back as far, but I'll show you what I mean with an example closer to where price is currently trading. Let's take, where's a better example? Take this trade here, right? So this trade was in early June 2019, June the 4th, 2019. So if you entered on the close of that day, when the pattern appeared, you would have been risking 75 points, right? For 160 points, 2 to 1, right? Is there any way we can boost that? Well, of course there is. We'll try and enter intraday somehow, whether that be a pullback or breakout, lining up the daily chart with the intraday time frames, and see what that does to the risk to reward of the trade. And we'll also add the other 3 layers of edge in there. We'll also use the money management, as in going small and then build up a position, rather than going in full size and taking full size losses. So we're looking for June, right? Here we go. So here, so our bullish engulfing candle on the daily would be June the 4th, would be this day. We closed up here. So we've got this trend line. You say, well, you know, we break above the trend line. We're going to try and get long on this day, either via a breakout or, can I zoom in on 15-minute? This is November. Sorry, guys. Just got to get back to June. And is it going to get back there? Sorry about this. Right, so here we go, June the 4th on a 15-minute time frame. So then the entry is look at this off the off that trend line that we drew on the daily. You got a really nice hammer candle off of that trend line on the daily. It was also the low of the morning, an entry there, but look what happens to the stop, right? Instead of risking sort of 70 points, we're now risking 7, right? So we're now risking 7 points. I'm going to go back to the daily. So we're now risking 7 points for that same, on this trend line break. and then for that same 150 points. So you've now transformed that 2-to-1, 3-to-1 trade into 21-to-1, right? And you've sort of put the first size on, and you've sort of on dips intraday or on breakouts intraday, just adding a little bit. You're sizing up and sizing up and sizing up into the trade, so that when you're wrong really small, and when you're right, you're in full size. And obviously that would transform a strategy like this, that was sort of, you had your, what was it, your 2,200, your 2,300. Well, now we're messing around with sort of 20-to-1. Now we've got your, what, we're risking 100. So we're risking 100. Excuse me. So we've got 100 times 20, which is 2,000. And we had 6 of those winners, which is what, 12,000? 2,000 times 6 times 6 is 12k. You've got 12k worth of profits, and you've got your sort of, not sure. The trouble is, obviously, with entering intraday, is that you would be taking more losses. But let's just say we took even like a originally, but the losses are smaller, remember, because you're entering smaller. But if we had, it doesn't make a difference. You can already see the difference is that what we were making sort of $2,000 profit out of those 6 winners, but now you're making 12k, and there you've got 4 layers of edge, right? So you've got your strategy was just to trade tests of the 200-day moving average on the S&P. That was the core of the strategy. Layer 2 was you were going to wait for some bullish price action off of the 200-day moving average, which should increase the win rate, although it didn't. No, number 3 was going to be the money management, and then number 4 was layering up the time frames to tighten up the stop loss. And now those layering those forms of edge and using money management as an edge as well has created a profitable trading strategy. And yeah, you don't get the signals very often, but it's a great strategy, and the win rate's so high that you could compound very aggressively. That could be another layer of edge, but I guess the point is there's tons of technical tools out there, and intraday you've got your pivot points. Well, entering into a pivot point, every single pivot point might not work, but what about when the stochastic's oversold? What about if we get price action off of it? What about if it lines up with something else? And you're building these layers of edge. But the real important thing is not just to trade multiple edges, but if this is your edge, that's the trade, and that is the only trade. You wait for that setup, and then you wait for all the layers of edge, and over time it will start to build money, because if we're trading multiple edges at the same time, they'll start to interfere with each other, and then it doesn't work. So I hope someone got something from that. That's me finished with this little chat, layering edge and what edge is, and how to improve the edge over time. Just going to answer this question. Oh, I think I know what you mean, Charlie. So but if it bounces off the moving average, if it comes back to using a break-even stop loss is potentially another form of edge. Although, on higher time frames, maybe you just want to keep the stop loss where it is, because sort of I don't know the answer to that question. We just have to test it and find out. That's what's great about testing. I know a lot of people give back testing a bad rap, but I quite like it. You can see what happens. It's not perfect, obviously. How long on average does it take till it comes back? What, how many signals are there? Yes, this session will be recorded, and I will post the link into the chat for the YouTube channel, which is Alex Clark Trading. Yeah, exactly. So Parwitz, great question. Would you trade a specific edge for different market movements? If it's a trending market, then an MA-based edge makes sense. But if it's a ranging market, it wouldn't be so effective. So I will very quickly, as we're running out of time, for a ranging market, you would use a different edge, absolutely. For a ranging market, you would use a mean reversion edge. So you'd be, as price moved up, you'd be looking to get short. As price moved down, you'd be looking to buy. And that's where things like, let's take this range here, for example. Right, we've got this range here on the euro dollar. How you define the range, but you'll notice that this is on an hourly chart, right? But if we sort of scroll down to 15-minute, a mean reversion style strategy will say, when we're in a range, every time the stochastic goes oversold, I'm going to buy, right? You would have bought here and price went up. And then when price is oversold on the stochastic, well, I'm going to sell, and then price will come back, and you'll realize that actually on its own, that doesn't work. So then you'll want to add another layer. Well, what about if there's support and resistance in the area? You know, well, it didn't even reach the support there. And some of the layers will actually make the strategy worse. You know, you might, and then you might say, well, what about a zone of support? You know, so then you would have a zone of support and an oversold stochastic, and then the target would be the high. And so then you'd be buying the low, and then there's a zone of resistance up here, you'd be selling the high, and then we come down and we've got, you know, and then you could layer in the money management as well. So in these ranging markets, you play a mean reversion, but then you also want to know when does it break. If it breaks to the downside into a trending market, I'm not going to be using mean reversion in a trending market. You know, we go back to using the trending methods. And yeah, to answer the second question, would that be too much? I'm a trend trader. I just stick to trend trading. I hardly ever trade. At the moment, I've traded like 3 times this month, but I trade those quite big. I'm trading the big price swings. But your thing might be mean reversion. So you're just trading mean reversion, mean reversion. You're looking for ranging markets. But I would say specialize somewhere. Either specialize in mean reversion and ranging markets, or specialize in trending and trending markets and trending edges. But don't try to, you don't need to do both. You just need to get good at one thing and find your niche, find what works for your personality. Is there any other questions? Otherwise, I'll wrap this up and post it on the YouTube. No? All right, lovely. Thanks for listening, guys. If there is any questions, hit me up a bit later. All right, thanks.